Welcome to this special edition of Trade the Trend, where the focus will be, will commodities continue to rise? I'm Jason McIntosh. It is Saturday, the 9th of April 2022. As always, this is general commentary and doesn't take your personal situation into account. Okay, now before we get into this first chart, if you are watching this week's regular Trade the Trend, I'm sorry about the abrupt end of the video. I had a technical issue and cut the recording midstream, so I'm back today with this special edition to finish everything off. If you missed the first section on equities, I'll leave a link in the description below, and you can just patch into it there. All right, well let's get into this special commodities edition. So, really interesting chart on the screen now. This is the uranium price, and what we've got in uranium is we've got a break to a new. Geez, what is it? It's the highest level since 2008. So it's what's that? It's a big breakout. It's a big move here that we're getting in uranium. And what I want to do, I want to go over to the weekly chart and just put some perspective around what we're seeing. So let's just compress this a bit. And so look, here we go. This is from around 2005 where the data begins. And we had the boom, we had the bust, and then over this period here, probably about what's that? That's around 3 or 4 years. We had this rounding, this base formation start to appear on the chart where we just started it was just grinding. It was a grind sideways. A lot of people lost interest, came off the radar, and that's so often how commodity markets and also stock markets bottom out with disinterest. And what we've been seeing over the last couple of years is we've been seeing this ratcheting higher. So we'd have a big rally, and then a fairly decent sized pullback, a rally, then pullback, and just over the last, probably since about mid last year, we've really then started to launch higher off this big basing pattern that we have, this rounding bottom formation. We're now launching off it, and this is really turning into something which is becoming very interesting. And so let's just give us a little bit more room. So the thing with where we are now is I'm looking at where the price is relative to its moving averages. So I'm still on a weekly chart here. So this is a 50-week moving average and a 100-week moving average. And the thing with moving averages is, and I've said this before if you're a regular viewer, moving averages act a little bit like gravity in terms of as a price, whether it be a stock or a commodity, it pulls away from those moving averages. The moving averages have this gravitational pull back to it. So at some point, the further it gets away from those averages, the more likely it is that we're going to have this return move that's going to come back, and it just keeps that rally in check. And sometimes it can tear well and truly away from the averages, and when that happens, not always, but a lot of the time, it results in a bust. So this ebb and flow around the averages is a good thing. So this is where we are now. We're well extended above the averages. So it comes down to what do you do here? It's like when I look at this chart, I think it's a really bullish chart. I think over the next, always hard with the timing and the time frames of these things, I think over the next maybe 2 to 3 years, I think uranium can get back up here and exceed this all-time high. But it's like, how do you get in? If you're already in, it's quite simple. If you're in the uranium market at the moment, it's simply a case of hold on to your positions. There's nothing to see here, nothing to do. This is all going well. If you're not in yet and you want to establish a position, it gets trickier because you need to assess the risk and reward. So I look at this, and this isn't a particularly asymmetric entry point. In that asymmetric is where you want to have a relatively small risk for an oversized gain, for the potential of an oversized gain. And it's tricky here because where do you put your exit stop on a move which is moving so quickly and does have the potential to pull back to these moving averages. So there's a couple of scenarios that are possible to play out over the next maybe the next month or two, we could see the uranium price. Well, we could see it move a touch higher, and then maybe that gravitational pull kicks in, and we do get something like that over several months. And what that would do, that would allow the moving averages time to sort of like catch up, and then once they catch up, then you get it allows the market to start doing that and moving for another move up, and that's a standard bull market. It's constructive price action, it's breathing, it's doing all the right things when you see a market doing that. That's entirely possible. So if you're not in at the moment, it's a case of like, do we get a move like this? Does that set up another entry opportunity where you do have points where you go, okay, I know where I can exit if it continues to, if it doesn't kick higher, or I buy into a new breakout. That'd be a great way if you don't have it, or if you want to add to positions. Another possibility that could happen, and this is the thing. So if you're holding uranium now, some people would think, okay, there's probably going to be a pullback. I might sell. I'm going to take some profits, and so many people do this. I'm going to take profits and I'll buy when it pulls back. There's a risk with that though. There's a risk that uranium goes into a move like what we saw here, where it just absolutely accelerates to the upside. That's not my base case. I don't think that's going to happen. But the thing to remember with uranium is it's really is, on a global scale, it's a small market. It's much smaller than the gold market. And if we saw significant money flow coming into the sector, it could really ramp the price upwards quickly. So there's always the potential that we get a sharp move upwards like that from current levels. So this is why I wouldn't be exiting any positions at this point. I would be letting the trend run. And this is the thing with trend following. Trend following is such an interesting strategy, because the way it works is, with trend following, you get lots of relatively small losses along the way. That's just part of doing business as a trend follower. You get into lots of trends which go a small way, a modest way, maybe lower double digits, nothing very exciting. Then you get a whole host of losses, trends which just fall short of what they could have done, and they basically roll over and fail, and you end up with 10 and 20% losses. That's all okay. They all kind of net themselves out. Where the trend followers really make the big money, where they kick their goals, is when they get into a mega trend. And this is a trend that might go, well, look, when they get into the big trends and mega trends. So a big trend is like a triple digit gain, 100, 200%. They come along reasonably frequently. But then occasionally you get the mega trend, and these big trends, that's what make the portfolio. That's what makes trend followers so successful over the medium to longer term. That they're at least the ones who can stick with it and follow the process. So I'd be hesitant to buy at these current levels, but I'd very much be sticking to my positions if I had them on board. So I think the outlook for uranium is looking very good, medium to longer term. Let's jump to a couple of the uranium stocks. So we'll start with Cameco. So Cameco is the largest listed producer, Canadian-based company, and look at it during the last bull market. It went from kind of where it was a couple of years ago to that was a huge rally. Let's just measure that out, just for interest. It's not to say it'll do that again, but that's a 1,760% rally. So as I say, it's small market. When it gets going, it can do big things, and this is why you don't want to short circuit your profit potential by trying to be too clever and jumping in and out of these potentially these very big trends. And just looking at it now, again, it's just not a very asymmetric entry point into a stock like Cameco with where it's come at the moment. Again, stretched above its moving averages. If I'm on board, I'm staying on board. But am I going to enter here today? Probably. Look, no, because my risk is I'm pretty conservative the way I manage my portfolio. I don't like taking on high risk. I like to keep my risk tight and my upside big. and I just don't have those dynamics around Cameco at the moment. So there could be a better entry point a little bit later on. I'll show you the stock which I've got most of my position in. It's this one here. It's called the NorthShore Global Uranium Mining ETF. It's a US-based, US-listed ETF. I got into this stock back in December 2020. It was around about here. So this has been a great trend. But the thing is, trend following is medium-term trend following. It's so hard for so many people because of the pullbacks, because of the drawdowns, and that's again, it's part of doing business with a trend following strategy. And that like this here, like you just look at some of these pullbacks. So that was a 30% pullback, and that was a 37% pullback. They're tough for a lot of people to sit through. Like a lot of people will struggle with a pullback like that, or a pullback like that. They're relatively small. They're like 10, 15% pullbacks. And this is why if you want to potentially stay on these, what could be, it may not be, what could be a super trend, a mega trend, you've got to give them lots of room to move. You've got to have wide trailing stops. And that's what I do through my Motion Trader subscription service. It's calculating wide trailing stops to help my members, my subscribers, stay in these big trends. And that's what I've been doing. And it's and these moves don't always happen quickly. So just looking at from my own entry point, this is up 190% thereabouts at the moment. And it hasn't happened overnight. It's been since December 2020. So they take time. You also need the patience to ride with them. It's look, I had a really interesting email I'll just quickly tell you about through the week. It's from a new subscriber to my Motion Trader service. He sent me an email. He's been with me for 3 weeks. He said, look, I want to cancel. I'd like a refund, please. And he said, really love what you do. Wish I found you 10 years earlier, but I need to make money quickly. I need to make money quickly to help my family. And when he said that, my heart just really sank for this guy, because if you've been in the markets for a while, you know that the market doesn't work on anyone's timetable. The market doesn't care who you want to support, what you want to do, what you want to make, how quickly you want to make it. The market's going to do what the market's going to do. All we can do is look for the setups and trade those setups accordingly. And people who are chasing fast dollars, they're often attracted to that. You'd see those promotions all the time where you see a promoter saying, if you'd put $1,000 on this stock I tipped 6 months ago, you'd now have $10,000. Only problem is they don't tell you about all the other stocks which went down 80%. So it's very tricky. It's people want to promise fast dollars, but it's just not the way the market works. It's I'm reminded by some wise words an old seasoned investor told me early in my career. He said, Jason, if you want to get rich slowly. And you know what? He was spot on. That's what I've done. It's the guys who chase fast dollars, take big risk, have high leverage, and they inevitably almost always blow up. So yeah, if you're after a fast dollar, I'm not the guy to guide you, I'm afraid. So so look, there's the story of NorthShore, and it's about wide stops, and it's about patience, it's about staying on those big trends. Now I'm going to jump to a couple of other stocks which do potentially offer some entry opportunities. They're ASX listed uranium plays. I'm going to start with Boss Energy. So this is an interesting stock. It's been a big uptrend since 2020, and then over the last 7 months, or since around September, whatever that might be, that's been in this consolidation. We've been in this extended consolidation or a trading range. And I think this is going to be I think this could be a base or a staging post for the next advance. So I actually bought some of this stock during the week. It didn't strictly follow my momentum play, but sometimes this is more of a discretionary trade which I took. It's still all based around my trend following principles, but I've used a risk assessment approach to buying this. So let me explain what I mean by that. So I'm working on my big picture view of uranium, and I'm working on the upward momentum I'm seeing in the uranium price. what we've seen in this stock since February, we had a sharp move upwards, and this is where I don't like buying stocks. This is a bit like Cameco at the moment, like, you know, just like there, and you can see, you know, like here, where the stock runs, it gets well above its moving average. You know, gravity's pulled it back down. So I don't like buying it when they're extended, because even though the trends may still stay well and truly intact, you can wear quite a bit of pain when they pull back. So I don't like buying up round here. But then we got the pullback. You know, gravity pulled it back, came back to those moving averages, also formed a support base through there. You can see these three touch points. So it was just last week I bought a position on I think it was around Tuesday at around $2.33. So it must have been around here. And so my reasoning was I was buying just above support, and I reasoned that I could put a stop loss just around here. So only about $2.10, maybe a touch lower, but around that $2.10 mark. So when you work that out from a stop loss percentage, I had got about 10% of risk. I'm risking 10% to get into a stock which has the potential, should this range break to the top side. So I've already got a little bit of a run already. Should this continue to break out of this range, it's a stock that could over the next few months, or maybe over the next 12 months, don't know the timing, it could well and truly find its way up to $4 and beyond. And so I'm in at 233. So look, it's got the potential to, it could double, it could triple, it could quadruple, and I'm in for a risk of 10%. So that's what you call asymmetric risk reward. I've got relatively small risk, I've got big potential upside, and I'm getting into a stock which is potentially going to be carried along by this, what could be a megatrend. Uranium could be, it does have the makings, it has the potential to be a megatrend. Maybe it won't be, but we never know. We never know in advance. All we can do is work on possibility and follow trends, and it's setting up. And just on Boss Energy, really interesting stock. It's not producing at the moment, but they're close to making a final decision on a site in South Australia. It has something like, they say they could be producing something like 3.3 million pounds of uranium per annum, which would make it a globally significant producer. And they think they could be producing uranium within 12 months of a final decision, which they expect to make soon, and they expect to make a positive decision. So really interesting play. Now another play is Paladin Energy. So this is interesting. You can see this, what I've drawn in here. So I just take it off a moment just so you can see the price action a bit clearer. So we had this strong move up in September with the uranium price, and then uranium started to consolidate, went into an extended consolidation for several months, and Paladin started to drift back. And as you saw, what you can see, this like, to a lot of people, I guess this is just a lot of up and forth and back and forth and just a bit messy, but you can actually get to see the patterns. It's so interesting when you can actually pick the patterns. And you do get this. You get this. It's a little like in technical analysis. One of the patterns is a flagging formation where you have a strong move up, then you have a sideways move. So it's meant to be shaped like a flag, and then from there you get a break out to the top side. That's the theory of a flag. It goes for another run. This is probably a little bit too big to call a flag. It's more of a downward sloping trend channel, but it serves the same sort of purpose in that it looks like it's a consolidation of a run. And now we've got the breakout. So you go, okay, where could this go from here? And well, it's the same sort of situation as Boss Energy. So unlike Cameco, which feels like, you know, it could be somewhere like here, getting stretched from its moving averages, this one's just bouncing off its moving average and it's broken above a downward trend line. So, you know, maybe we get some near-term consolidation, and then it starts to go higher. Don't know, maybe it doesn't take a path like that, maybe it does, but that sort of general sort of feel, that potential, that's the potential that it has. Let's just quickly look at this on a weekly chart, and it just shows you what can happen in uranium. So look at this. It's like, I don't know whether it ever gets back to this all-time high. Like, I don't know about that. Who knows? But even if it were to get to $3 or $4 from where it currently is at 90 cents, we're talking about big triple-digit gain potential. So I want to get into stocks like this with good risk-reward parameters and then ride that trend for as long as possible with a wide trailing stop. And these are portfolio makers. They can really set up your portfolio for a really strong year or two or three, because you can stay on these trends potentially for 1 to 3 years for a big medium term uptrend. Like a move like this was entirely rideable, and then with the trailing stop probably would have got out somewhere around here. So you always give back a portion at the end, but it's this big piece here that you capture, and that's I keep saying it's where the trend followers make so much money. Okay, so that's Paladin. That's an interesting one, which is shaping up and is looks like it's in play now. Let's watch how this one shapes up over the next few months. And look, if you're getting some value from this, please hit that like button and leave me a short comment. Even if you did in the previous video, look, just even a like would just be fantastic. If you could please double up on that, really does help me. Lets YouTube know people like what I'm doing, and if people like it, I can keep making them. Now I want to jump over and have a quick look at oil, because oil is really interesting at the moment. So where do I have oil? Here's my oil chart here. So okay, so it's been a huge move since the COVID lows from below 0 to over 100. So it's been one of the great trends, and again a very tradable trend. But let's zoom in on the last few months. We'll look at this move from December, and so we were having it was trending nicely, and then with the invasion of Ukraine, we had a sharp spike upwards. So that looked a bit like a blow off top when you get that strong acceleration, and then again with asymmetry. Buying when a stock's so far above, or a market so far above its moving averages. So often, gravity pulls it back down, and that was the case in oil. Came back to the moving averages, had a bounce, it's come back now for a retest. Very interesting. Let's put some Fibonacci retracement levels on this. And what you see is that the market's come back to around the 50% retracement. So pretty textbook stuff there from a Fibonacci perspective. And what we can also do, we can also put on some support. So let's look probably around about here. You find there's a support band that comes through, picks up some highs here, picks up a low. We've got this point here. It's not a confirmed low point yet, because maybe the market continues to come down. But it's shaping up as a support band. We've also got the 100-day moving average coming up here. So we've got this cluster. We've got a cluster of supports coming in. So let's continue talking about asymmetric risk reward. This is a little bit like the position I recently took on Boss Energy, in that you could buy into the oil market. Like all the oil stocks have got different profiles. Oil stocks don't necessarily look the same as this. This is more for the education of like how these moves can play out. And but if you have the ability to take a position in the oil market, maybe it's something to consider. I'm not doing this trade. I'm invested elsewhere, but nonetheless, it's really interesting to look at. So you could have a stop loss on oil around this mark here, which is around $89. Price is currently at $97. So you're getting in with a pretty small risk reward. A pretty small risk, relatively small risk, but you've got considerable upside. So if this support holds, you've got the potential that it bounces off there and then continues up and makes new highs. Whether that happens, we don't know. We don't have a crystal ball. I'm not about making predictions about what's going to happen. I'm about looking for possibilities of what could happen, and then looking at the risk and reward dynamics of those setups and going, well, if I play that setup consistently week in, week out, how am I likely to go? And I think if I play this sort of setup consistently, I think I'm going to do well, because I'm going to get a number of times where this support doesn't hold, it's going to come back, it's going to hit my stop, I'm going to take a relatively small loss. But I'm going to get other times where I get the bounce, and then the trend re-engages, and you can make a lot of money. So that's how I'm looking at the oil market. So this is just an interesting one to keep an eye on over the next over the next few weeks, next month or so. Let's see whether we do get a bounce off there, or whether it does come back and have a more extended consolidation to this big rally we've had over the last couple of years. Okay, so I want to finish up today by looking at gold. Just a quick word on gold, because it continues to be interesting it continues to be setting up really well. So last week we were speaking about gold, and not a lot has changed, and that's actually a really positive thing, very positive, I think, because gold's continued just to track sideways in a relatively tight range, and it's doing so above support. So I think this is good, because it's reinforcing and it's strengthening the foothold which gold is getting around this point here. And I think the longer it does trade sideways, the stronger this base becomes. And what I'd love to see in gold would be just to see it just continue to grind sideways, and then it starts to ratchet higher and regain momentum, and then that is what could take it up to new all-time highs. That would be textbook. That would be the perfect play out of this trading range that we've had. The initial run up, we've had the return move, the consolidation, and then the lift off. That would be the ideal way for this to play out. And we put on those Fibonacci levels, those Fibonacci retracements, and we can see that it's come back to the 61.8. It's got support. It's come back to the 50-day moving average. It's looking really good. This is again, this is one of those asymmetric plays, in that we know if we buy gold, and also the gold stocks have the same setup. A lot of the gold stocks have the same setup. In Australia, it's Northern Star, Evolution, and Newcrest. They all look similar to this. A lot of those mid-tier North American stocks look like this. Barrick and Newmont are a bit different. They've already run, but there's plenty of opportunity to get into stocks that look like this. And risk. Where's your risk? Well, your risk is probably around about there. So if this doesn't work out and gold comes back and starts to break down, well, we know our point of retreat. We know where we can rule off on this trade and just put it on the back burner. Because I think if gold comes back down and it gets back within this range, I think that puts the near-term bullish potential on hold, and it means that we potentially then get a retest of these lows. Because that's the alternate scenario. Like, the big question for gold has been, we've got this longer term bullish trend. The question is, did this consolidation end with the breakout from this range and we're now getting ready to go up? Or is there still part of a big sideways consolidation, and maybe we have a retest of the lows, and then later in the year or even next year we then get a big lift off? Maybe something completely different happens as well. But they're my two favoured scenarios, but look, we don't need to worry about this one at the moment. We just know why we have an escape plan. Like, I've got longer term gold holdings which I won't exit if this comes down, because I'm staying with an even longer term trend, giving that even extra room to move. But some of my more tactical positions I'd consider cutting should we break below that support there. But that's not the problem for the moment. The play now, I think the play we need to go with on gold is that we've got the breakout, we've got the pullback, we've got the consolidation. It's set up. We've got a base, and I think we've got to give the bullish trend the benefit of the doubt. And if it continues to run, we'll take our trend following approach. We let that trend run. And if it stalls, we take a relatively small loss and we move on to the next opportunity. So some really interesting things happening in commodities. We've got uranium running, gold's running, silver looks interesting. Copper still looks to be in play. there's lots of interesting stuff going on. So will commodities continue to rally? Well, I think over the at least over the short term's tricky. Medium term, I think yes. I think we're going to see higher levels in commodities. So hope you found this special edition interesting. Please give me a like if you got some value, and I look forward to coming back at the regular time next week and talking to you again. Until then.